A rejection pattern in trading, also known as a reversal pattern or a false breakout, is a technical analysis pattern that occurs when the price of a financial instrument such as a stock or currency moves in one direction but then reverses and moves in the opposite direction. This pattern is often seen as an indication that the market has rejected a specific price level or a particular trend. The rejection pattern can be identified by looking at the price chart for specific candlestick formations, such as pin bars or long-tailed candles, which show that price tried to break through a support or resistance level but was pushed back. These patterns usually consist of a long wick, or shadow, and a small body, indicating that the market attempted to move in one direction but encountered significant selling or buying pressure, causing the price to reverse. Traders and investors use rejection patterns as potential trade signals, as they can help identify potential trend reversals or significant levels of support and resistance. If a rejection pattern is spotted at a key level or in combination with other technical analysis tools, it can provide valuable insights into the market's sentiment and possible future price movement. Once we see a rejection from a resistance/support level, we want to see candlestick rejection in the opposite direction to confirm it. If there is no impulsive move after support/resistance touch, there is no entry. The stronger the rejection, the better the confirmation. Here are some examples. In this first example, the third candlestick is not bullish enough. This is not a good rejection. In the second example, there is a pretty good bullish third candlestick. This is a decent rejection pattern. And here we have a strong bullish candlestick. This is a good rejection pattern. Finally, it's essential to consider other factors and use proper risk management strategies when trading based on rejection patterns, as no single technical analysis tool can guarantee success. Thanks for watching.